here we go. Ready to go. All right, we're rolling.
It
is Monday, March 10th, 2025, and this is Momentum Mondays. My name is Garrett. This is Matt. It's a podcast we do for clients and prospects alike, where we dive into what happened last week in the markets, what we think what interests us in this week in the markets, any economic events, anything like that, as well as, any kind of hot topic in the news as far as markets are concerned. But I always want to kick it off with the fine print, so I will kick it over to you and let you do that, and we will start it.
Yeah, before we dive in, just a reminder that all information shared during this podcast is for educational purposes only and should not be considered financial advice. Always consult with a financial advisor you trust before making any investment decisions.
It's a good way to look at it. Mm-hmm. All right, so we're going to show we have historically showed it's not really a chart. We're going to do a chart now. We're going to change the way we show the return data from the week prior and then the year to date and all that kind of stuff. So if it's just awful, give us some feedback on it. But we're going to go forward with that. So we look at, well, you know what? I do have it right here. So we look at the indexes for the week. The Dow Jones is down 2.25. The Spider, which is the S&P 500, down 3.24. Your Triple Q, which is the NASDAQ, is down 3.45. And the Russell 2000 down 4.61 on the week. Not a great week. Very, very not fun.
Markets do go down.
Markets do go down.
If you're new to investing...
Welcome to the party.
You just learned that markets do go down, which people are asking, is it a buying opportunity or should we run for the hills?
I mean, we'll talk about that in a little bit. The 200-day moving average is something people kind of look at for the S&P in particular. It did close above that last week, which was a good sign. But here we are Monday morning, and it's for sure below that at this point. So we'll see how the day ends up. 1 week in commodities, we got silver up 3.68%, gold up 1.46%. The 10-year treasury is down 0.59. If you remember correctly, we talk about the yield or the price moving down, and the yield would move actually up. So we had a little bit of a change last week from what we had seen the prior weeks. And then Bitcoin down with 4.30%. Silver kind of had a lot of ground to make up because the week prior to last week, it was down a whole bunch. And so it kind of came in and had some recovery to make up. If we take a look at the indexes on a year to date, this is as of Friday's close. We're not taking into account any of this that's happening this morning. But the Dow Jones, you've got up 1%, a little over 1%. The S&P's down almost 1.5%. NASDAQ down 3.61%. And the Russell 2000 way down at the floor, down almost 7% year to date. We look at commodities on the same track. Silver up 9.88, gold up 9.36. Your 10-year price is up 2.04%. And then the Bitcoin, is down obviously 10.7. And this is a hard thing to pinpoint with Bitcoin specifically because it does trade around the clock. And that is difficult when you're trying to get measurements of performance to compare and contrast with the indexes that are represented that only trade during a 5-day week. Some talk that they're maybe going to look at changing that eventually at some point. That would be interesting.
It is. It can be confusing because it's 24/7. So there's no, like you said, there's no stop and go. And a lot of times you can pull up, let's say if you're using CoinMarketCap or CoinGecko to look at your crypto positions, and you'll pull up and say, Bitcoin's up 12%. But it's the same price as it was when I looked at it last night. Because it's 24 hours ago, it was 12% less.
Yeah.
So I think that
you actually have like 1 hour. You can watch that whole thing a minute. You can watch whole thing during the weekend on those charts.
And they're generally speaking, that's when you have the biggest volatility. So, for instance, our clients that are in and have been for some time in Bitcoin and Ethereum ETFs. You actually don't experience most of the volatility because it happens on the weekend. So you can close Friday with, say, Bitcoin at 90, it wicks down to 78 and back up to 87, and you open on Monday and they're talking about, Bitcoin had a huge correction, but you look at your account and like, well, I'm down like barely anything. And that can help provide a little clarity if you're in some of the regulated products, which honestly, if you're not a crypto expert, that's the best place to be. You don't have to worry about the crypto keys. You don't have to worry about dealing with exchanges that are not necessarily the best, because there's really only a handful. There's really two really high quality U.S. exchanges. That's Coinbase and Kraken. So if you're not, using those, which a lot of people use some of these weird, Gemini, I guess, the Winklevi twins. Those are all. The regulation is coming to help them, but they're either publicly traded companies or soon to be publicly traded companies. So from a regulatory perspective, that's pretty safe. Do your own research, but yeah, they're regulated.
Pretty safe.
Yeah. I mean, I use Kraken. I like it.
You still have to keep on top of things, even if you are, with the crypto, the keys and the passphrases and all that kind of stuff. That is a world unto itself.
Well, they've gotten rid of that now for your main Coinbase and Kraken accounts. It's just like your E-Trade. So they've gotten rid of that.
They're not doing pass keys or anything?
Nope. It's just
It's been a while since I've signed into Coinbase.
And I've even seen on some Solana addresses that you can use your Apple ID. So now you can create, there's no keys with that. It's just your Apple, which is pretty secure. I mean, again, do your own research.
Pretty secure based on where you live.
Yeah.
Yeah, you've got some EU regulations that are, we'll talk about in a minute.
That's crazy. I wouldn't. Yeah.
But, moving on, looking at what happened last week, we had a pretty broad sell-off, and it was attributed to a lot of things. Market breadth, obviously, BREADTH, our favorite word here, market breadth, was it bad breath? Was it bad breath?
It
was bad. Yeah, it was bad breath. More stocks declined last week than advanced. Not great for, seeing a progressing bull market. But again, here, you say that, and this does happen in a bull market. Even in a bull market, you have these pullbacks. We send out a chart. I don't have it with me right now, but there's a chart we send out via email quite frequently to our client base that shows the intra-year pullbacks generally seen within the S&P. And this is, right in line with that. We had the NASDAQ 100 closed below its 200-day moving average. And if you're looking at specifically the Mag 7, which was 7 stocks that were in the news, that have been in the news for like the past 24 months.
Name them. What are they?
Tesla, Microsoft, Apple, Google, Amazon, NVIDIA, and Microsoft.
Facebook.
Meta. Yeah. I always forget.
Man, you got them.
Yeah.
Golly.
Well, I was just looking at this. You know that it's kind of unbelievable. There is about 33% of the makeup of the S&P 500 is just those 7 stocks. And when you get to the NASDAQ 100, it's 50% of that index are those stocks. So it begs the question, are we seeing this insane volatility because these are high-octane players that are at high highs one moment and at low lows the next moment?
Big run-ups. And anytime you have that parabolic up, you're always going to have a correction. You're going to have people taking profits. And most of the time, it does eventually get back, and starts its next run.
Right.
That's a great point, though. Is we're seeing the volatility?
Is it so wild right now because it's so skewed in the holdings of these index funds? Because you're seeing this whether you're in a managed portfolio or whether you just have like SPY and a Robinhood account or VOO or
because we all use these to anchor, generally speaking, when you're working with an advisor, regardless of the strategy and methodology, which we can do a podcast one day to kind of go a little bit more in depth of our methodology and how we create and manage our portfolios. But generally speaking, most of your advisors, even if they're using like we are a proprietary methodology, you're going to anchor those portfolios in the indexes. That's going to be your core equity anchor.
Right.
And then from that, you can augment the portfolio based upon what sectors you want to be in, how much risk do we want in the portfolio, et cetera, et cetera. So yeah, I mean, it is crazy to see, but I know we mentioned last week when we looked at, or it just talked about the example of going back to the year 2000 after the .com crash, and you looked at Amazon and Apple and Microsoft and how cheap those stocks were relative to where they are now. They really carried the indexes to all-time highs year after year after year. And it could be which I know we're going to get into the bullish case in a minute, but if the bulls are right, that we're just at the very beginning of this transformational
multi-year.
I mean, it's going to be a lot of wealth creation. We could be seeing the same thing unfold. We're coming out of the what are they calling what happened in 2022 and 23?
Bad.
Yeah. That crash or whatever, coming out of that, we could be setting the foundation for the Mag 7 to do
crash. It was a decent pullback. It was down
a bear market.
22, 23%, something like that.
Well, but your high beta plays.
Well, that's to be given though, because those are an order of magnitude different than your basic index, your S&P 500 or something like that.
Yeah.
So what I'm talking about, S&P 500 down, 20, 22, 23, something like that %. So if we're looking at the bearish case for why the stocks may be on a downtrend right now, why the market may be on a downtrend and there's no hope on the horizon. If we're that type of person, what would we say is a bearish case for the market not recovering? And actually, this is sort of a point where it's just going to free fall from here. What the people that are on this kind of bandwagon, the bears, we might call them, are looking at things like rising inflation. It's not a lot, but it is there. It's in the data. We've got slowing GDP growth. That's there in the data as well. Weakening labor market. Last week we had the jobs report. It added softer than expected jobs. The unemployment rate is ticking up because of the federal workforce is being offered buyouts and cutting jobs from different departments. What's that going to be like? We had the heavy sell-off in the tech sector with the Magnificent Seven. Russell 2000 is another weak point that we've talked about for a long time. I don't want to keep saying that we keep talking about the Russell 2000, but it's shocking how not in the game the Russell 2000 is. I mean, that's shocking. It's down 16% from November. And so you have, other companies struggling too. Apple, I'll pull this. We can pull this up. Here's a little show note for you. I've been editing these shows from the get-go, putting the whole thing together, editing it. Now we have an editor.
Jared.
It's great. These views are Jared. Yeah, shout out Jared. Great guy.
In Louisiana.
We have these videos are getting a lot more views. They're getting traction on social media, so we're going to be able to do some things that we weren't able to do before. So we talked about Apple. You and I did on the 27th of January, that show. And so now that we have an editor, I can say, hey, Mr. Editor, put that conversation in right here.
Now, here's something interesting about Apple. Apple slid, what are we, down 15% year to date?
Oh, yeah.
On Apple?
Yep. We actually had...
Just before we started, I was talking about the new 16. Ordered a couple of those, should be in today. Biggest update for that is Apple's artificial intelligence on those phones. And you have to get the new hardware to be able to operate their new AI, and that goes for both computers, tablets, and phones. So just think about the refresh cycle that's going to take place. If and when people really start, because pretty cool stuff that's on there, especially with how you communicate with Siri.
I disagree with that. I think that this is one of the reasons that they missed. I'm a huge Apple fan. I have been for a long time. All of my devices, my whole family's in the Apple ecosystem. I like the nice, cool stuff they've come out with.
Trying to see if pigs are flying.
Apple has had an issue, and a lot of people talk about this with innovation. They've had the innovation issue. They're generally behind when it comes to features that they like to release. But the kicker is that they can be delayed with it because they generally implement it in a better way than their competitors. And what happens is a few cycles later, you see the competitors start to adopt the way that Apple did it. You see this all across the board with from phones, back in 2007 when they had the first iPhone, operating systems. Now, Apple has borrowed a lot from Android and different operating systems for features that they were lacking, but they always do it in a different way, a slightly different way.
They slow roll it.
And they've done the same thing with AI, but I just don't think they've hit the mark. I think that it's, the creating the images and creating the emojis and all that kind of stuff is cool. What do you use it for? Do you use the Apple Intelligence on a daily basis?
I don't have the phone yet.
Well, there you go. I do, and I don't.
Well, you have the new one?
It. Yeah.
We talked about the fact that Apple AI was a nothing burger, that they were really struggling with this. And so Friday, you have a report from Mark Gurman at Bloomberg, which if you're anything about Apple stocks or anything like that, Mark Gurman is the go-to guy. He's very well sourced. He's got a lot of people within Apple that are willing to talk to him. He writes this article on Friday saying basically that Apple has delayed the Siri upgrade indefinitely because of AI concerns. And so this is not going to be something that they're going to skate through. This is going to be...
They're the incumbents now.
Yeah, this is going to be something that they're going to have to figure out. And I'll tell you what I think is the sticking point here. Apple is all about privacy, which is a great thing. We just talked about that. You have them in the EU with the regulations about backdoors on the systems that they just gave up their end-to-end encryption. Meaning, if you're in America, in the U.S., if you send an iMessage via text message to another iMessage, you and I, we message back and forth through iMessage. Those are end-to-end encrypted. Nobody can get into those messages without the encryption keys. And Apple doesn't keep the encryption keys. They're on device. And so I think the big problem with Apple and AI is that they're trying to do everything on device, and I don't think that is going to work right now. Maybe they come up with a solution in the future that blows all of our minds, that's on device, that's totally secure, totally private, but I don't think that's where AI is now. They have to have that data. When you use ChatGPT or Grok or something, they're constantly using that data to make the product better. And I don't know that Apple has a great way to do that. And so rather than saying we're going to go back on our privacy promise and not do it on device, and we're going to send it to servers in, Texas or wherever we're going to do it, they're just going to say we're going to delay it indefinitely. And it's going to have an effect. I mean, you look at their price right now. I don't know what they're doing today. I'm sure they're down. If we pull that up, yeah, they're down quite a bit, 5%. So it's a big deal. How many other companies are going through stuff like that? And that's the Mag 7. Obviously, NVIDIA's taking it on the chin. It's interesting. And then
that's the balancing act that all companies are going to have to be faced with if the conversation is purely anchored on privacy, being able to have control over your data, but still wanting to use AI to make your life better and to make your products better. That's the balancing
make your
act.
life easier.
Easier, yeah.
Yeah, so I mean that's the bearish case. The other thing is tariffs would be a bearish case. Tariffs have such an effect on the economy, yada yada yada. It's terrifying the markets. We're going to pull up another screenshot here from Vanda Research. They looked at basically it's an overlay of what happened in the Trump 1.0 term versus what we're happening now in Trump 2.0. It's almost exactly the same, and the tariff conversation was the same. We also talked about a few episodes ago. We wondered, kind of pontificated, I think this was even before Trump took office, whether or not the tariff trade would be a thing in Trump 2.0. Because we have 4 years of Trump. We know that it's a negotiation tactic. We know that he says on Monday, you're going to have 25% tariffs. And on Tuesday, he says, well, we're not going to do those tariffs. So we know this. This is a thing that we know. So why is it acting the exact same way? Why are the markets responding the exact same way? Almost to you can overlay this. It's on the screen now. You can look at it. It's shocking. It's quite shocking.
I think that, so just before we detail objective bullish case, just some of my responses, the way when I'm reading the news headlines, which you have to be careful with, because when you're presented with news, you're being presented with that information for a reason. It's either designed to get you to click or it's designed to manipulate you to have a point of view that you didn't already have. And you have to be careful. That's with any type of news. You have to be very sober-minded and objective when you're trying to develop new perspectives and new points of view on something that you may had not really had a lot of information about. And so if you're new in the market and you hear things like tariffs and you see the market going down, you're automatically going to associate the two. And I just caution people, there's not a direct correlation to a negative market and a tariff, and there's not a direct correlation, believe it or not, to inflation and tariffs either. You look at China. China has some of the highest tariffs.
They have deflation.
And they have deflation right now. Yep. So
negative interest rates now over the weekend.
Oh, they're negative?
Yeah, they're negative.
Oh, wow.
Yep.
Did not know that. So it's interesting. I think that from a mid to long-term perspective on the Trump 2.0 policies, not the trade, but that chart tells you everything you need to know. It's seasonal weakness, using the headlines to scare people.
Yep. And you can look at the other chart that we have too. This comes from an analyst that I follow on Twitter. His name escapes me, Ryan. He's with Carson Wealth. Over the past 20 years, peaks in mid-February and lows in the second week of March are common. Could it really happen again? He puts a graph here where he shows kind of where we are in the moment. It's red. The second half of March is sort of where we find support usually. So is that going to happen?
That's this week, right?
It is this week. Could it happen?
It's possible.
Sure, it could. But could it also not happen?
That's also possible. I mean, I tend to favor what the charts that you're showing and that individual from Carson, along with some others. I tend to really favor their perspective because the tariff discussion and the tariff policy is not being done in a vacuum. It's being done with tariffs, number one. Really, it's reciprocal tariffs that are going to take place on April 2nd. It's being done with lowering taxes and it's being done with cutting government spending. So that's kind of the three-legged approach they're doing. So it's not just we're going to tariff, which then you could see a step change in prices one time. It's this entire new policy that the federal government's embarking on, which has both temporary price change, but also pro-growth and deflationary or disinflationary, specifically as it pertains to cutting government spending.
It's also not that big of a percentage of GDP.
No,
these tariffs.
It hurts the other countries. It makes them play ball. That's for sure. Because see, we're the biggest importer. So when we want reciprocal trade, or we want to have, most anyone listening is going to be able to drive through a small town on their way home from work, or maybe on their way to a friend or family member's house this weekend, and you will see shuttered manufacturing. You will see, I pass multiple times a week different areas where you have 100-acre plot that used to be a giant mill. Heck, our office is in what used to be it was rebuilt after Sherman burnt Columbus, or the troops from the north had burnt Columbus, and the mill was rebuilt started 1868, and the one we're in was, I think, 1886. And all of these production facilities are just vacant, or they've been turned into condos or nice offices. And so there is a whole change in the way people are viewing, are you willing to pay an extra $1 more for a t-shirt so your neighbor can have a job, right? And that's just a philosophical view, but as it pertains to like the pure definition of inflation, that's not it. Just like when your home value goes up, that's not inflation necessarily. There are other things. It's supply and demand. Everybody's happy when their stocks go up. Is that inflation? Everyone's happy when their houses go up. Is that inflation? It's a balancing act between when you're devaluing the currency versus when you're adding productivity, you're adding growth, you're increasing demand, you're also increasing supply of certain products. So, either productivity means something or it doesn't. That's what my gut reaction when I see the headlines about inflation and I see the headlines about tariffs and the market's going down. It's like, okay, it's causation or correlation, right?
Yeah, I mean, it's a cyclical thing for sure, but you also have members of the Trump administration, Trump himself, making comments that he's not looking at the market. This is totally different than Trump 1.0. Scott Bessent, the Treasury Secretary, is saying that there might be a period of short-term pain. The country has been addicted to cheap goods, to free, essentially, money, and this is not a path that's sustainable. You have to change that. And so
if you want growth in the future, if you want productivity.
That's right. Yeah. If you want everything to get back to a norm, you have to have some hard decisions. Now, does that mean necessarily that the stock market is going to crash or we're going to have a recession? You sent an article over the weekend. We can put this up too, Mr. Editor, about the Yahoo article that don't rush into the recession trade. Wall Street pros see opportunity. So this kind of brings us into the more bullish case for what we might be seeing in the markets and how this might be actually a perfect buying opportunity. This could be a good, if you're in a portfolio and you haven't rebalanced in a while, it could be a good kind of opportunity to do that. Or maybe you want to reposition some things, or maybe you want to get an opportunity to buy stocks like Tesla or, really any of them out there, I guess. I guess there are a few that are sort of weatherproof, but by and large, I think everything's pretty on sale right now.
I guess before, in that article, really, it cemented my own bias, which is fine. I mean, we all have our own perspective of what we're doing now. We're looking at the data to make decisions, but I did like that. I like the way it presented that, and it made sense. And in that article, you'll see two parts that I thought were really good. One, Dan Ives, which we need to tag Dan Ives. I'm channeling my inner Dan Ives with my colorful.
No one knows what that means.
I got the best dress. Google his name. I got the best dress today. I'm channeling Dan Ives. Tariffs add uncertainty, but it doesn't change the demand cycle. This is not going to end the tech bull market. It's a scare, but I see more an opportunity rather than to head for the hills. Then the next quote comes from another individual. The defensive trade is just that, a trade. So if you're getting scared, a lot of times people will want their advisors, or they themselves will go in and try to, I'm going to buy recession-proof stocks, so to speak. And she's right. That's just a trade. That's not a long-term strategy. It's just a trade. And, we are big fans of long-term strategies that we are able to look over a long period of time and know and have a high degree of confidence that they are successful in helping clients reach their goals. Now, she likes financials. She likes the use cases for AI, and then goes on to say that this is an industrial revolution like we haven't seen for 100 years. Use the weakness to add to your holdings. Now, with that, I want to circle back to Apple real quick. Because another person who is not, and when we mention people's names, we do not think that they are, God on earth. They are wrong. Doesn't mean that we like them, but
do I know who you're going to bring up right now?
Guess. Who are you going to bring up? It's not who.
Okay.
It's not, no. But I like ARK Invest research because they open source it.
Right.
So a lot of fund companies will do research, but they don't really tell you everything they're doing. ARK open sources it. And I think that's very interesting. She did a letter last year.
Kathy Wood, Aunt
Kathy, as she's called. And she's made some phenomenally good calls, and she's also had some phenomenally bad time sets of performance.
Would you argue that she came to popularity in COVID, the COVID 2020, 2021? Yeah.
Because she had disruptive tech, and that's what shot off.
Right.
But she wrote a letter I think it was in 2024, editor-in-chief. I'll send it to you if you want it. But she talks about disruptive innovation, and specifically in relation to what you said about Apple. Typically, truly disruptive innovation evolves as agile companies build from scratch, cutting against or undermining the competitive strengths of the incumbents. Yeah. Now, when you see how hard you're weighted to the index, or how much the index is weighted to some of these companies that arguably are disruptive, NVIDIA, Tesla, you could convince me of Google and Meta. Apple right now, like you said, is on the fence. I don't think they're going away. But as far as are they going to be the tip of the spear with AI? That's up for debate. But when you have...
And there are different conversations to be had around that from a time frame perspective, to her point in that letter. Maybe today they're not, but maybe in 2 years they are the forefront.
Oh,
and
most
that's
likely
a bet
with a company
that they're willing
like Apple
to take.
Yeah.
Maybe they're going to say, we're going to take this off the table now. We're going to do the engineering that needs to be done in the background, and we're going to either figure out a way to...
Or buy a company that's already doing it.
Or buy a company, yeah. Or we're going to figure out a way to take what we're doing in data centers all over the world and do that on this phone you're holding in your pocket, and it's going to blow everybody away. Or we're going to reconsider, and we're going to partner with somebody like OpenAI or one of these guys.
Yeah, it's interesting because when you have the indexes so heavily weighted to incumbents that may or may not be disruptive, and you're not working with a wealth management team to be able to, again, you want to anchor your portfolio in the indexes, but you want to be able to change your weighting so that you can take advantage of the disruption, because you can't always rely on the indexes because most of the indexes are large incumbents.
All right.
Not all of them, because again, Tesla, NVIDIA, they're not really incumbents at this point.
There are parameters in place to make sure that these companies are, worthy of being included in these indexes.
Yeah, and it's driven market cap generally. But anyway, I'll send this link to our wonderful editor-in-chief, and we can put it up there because it's just got some great. It's a great way to when you're drinking from the fire hose of new data and information that we are as technology improves and increases and starts to really touch our lives. It's just interesting to have these different perspectives, and I find that it gives people confidence to be invested for the long run because the best days are ahead, not behind.
Yeah, but you also have to balance that. We don't, but Kathy certainly does, and her team of researchers have to balance that with the fact that AI is the hot new thing right now. And so you have companies that are purposely adding AI to some part of their business so that they benefit from the growth trajectory that these other stocks these other companies are benefiting from. And so what is true like breakthrough AI, or what is just sort of like a grift, or just, a Band-Aid on a poor stock, right, to get some growth out of it.
Yeah. And that makes me think of a conversation we had last week with talking about the tariff discussion. I said, I guarantee you're going to see a lot of retailers, and you're going to see a lot of consumer discretionary companies that maybe aren't the best performing. Maybe it's their management. Maybe the weakness we've had in the economy for the past few years is really starting to bite, and watched them start slipping in tariff conversations, kind of blaming tariff on what could be poor management, lack of execution. And that kind of goes the same thing with, you could have a bicycle company change their ticker to Bicycle AI, and all of a sudden the stock can go through the roof. So, it's interesting.
That happened with Ethan Allen, where his ticker symbol was ETH until it was purchased by Grayscale like last year. Yeah, it was ETH. So they benefited from this run up because people thought they were buying Ethereum. Also, really kind of a public service announcement for people who may not be very comfortable buying stocks. That's a bold move to open an account and go into a stock based on its symbol and not know anything about the underlying stock. It is an Ethereum stock now. It's an ETF, Ethereum owned by Grayscale, but it was Ethan Allen for a long time.
You're thinking you're making money, thinking you're holding Ethereum, and you're holding a furniture.
Yeah. Well, they did well for a few years because a lot of people thought that. But you look at a company like Nike, and my Lord, you wouldn't think that that's a defensive stock, especially with the tariff conversation. That thing's up 13% over the past 30 days. That is wild to me.
Products made in China,
right?
Primarily.
Yep.
China's economy is slowing and has slowed. Still dominating. My God, the Tesla Model Y orders I saw over the last week, UK, South Korea, and forget the other country.
Is this for the
huge.
new?
The refresh. Yeah, I mean it's. So you have to take everything into perspective. The bullish case, some bullet points here is, yes, this could be a short-term pullback. I tend to have that bias. Major CEOs are buying back stock, indicating internal confidence. Positive earnings have been expected, and we are seeing some pretty good earnings. Oracle, Adobe, those are good signals for the economy. February inflation data is expected to be tame, easing
Oracle
pressure.
and Adobe both having some sort of semblance of AI also.
That's right.
That's
true.
With the tech and graphics, video editing, and all that kind of stuff.
And Oracle with the chips and the software.
Yep.
The Linux-based whatever it is they do. They do. I don't know. It's a big company. They do a lot.
He was one of the guys with Trump to announce this whole whatever they called it back when they were going to get hundreds of millions,
billions or something. Yeah. So then I think inflation data is going to be tame. If you look at nothing but the price of oil, rolling 12-month, it is down. And that is something that's also not being talked about. The price of oil keeps going down. That is an input for what you're going to pay at the grocery store and what you're going to pay to have your
everything.
Yes, absolutely.
Transportation costs are king.
Yep. And then you're seeing a visible rotation into defensive sectors like healthcare and consumer staples. And international markets are holding up better with non-U.S. stock funds gaining 2.2%. That also doesn't make sense with the tariff trade. If you think the market is moving in lockstep because of tariff policies, you would not have international stock markets up because they sell us everything, right? You would think that.
Yeah, that's an interesting one. I'm not really sure if we have enough information to have context on that yet. You look at that trade, which historically, it's the disbursement here is huge. Over a 30-day period, a stock like EFA is up 4% versus the S&P down 6.3%. So this is not something that we've seen over the past 18 months. Domestic has definitely been the leader. The U.S. has been the leader. So is this a rotation or is this some sort of temporary weakness? And then, certainly the major CEOs buying back their stock is a huge thing. You're not going to buy back into your company at these valuations unless you think the growth trajectory is forward. These guys are not dumb people, despite what, a lot of them may be less than desirable personality types, but they're not stupid. And so, that's one thing.
We need to also, I'd like to show the Bitcoin chart that I had sent you in reference to the halving, because, you can see right now we are having the same type of weakness in the equity markets that we're seeing in the crypto markets. But we take things into perspective and we look at the price action of Bitcoin post every halving. And this is kind of moving, like you were talking about with the chart of Trump 1 versus Trump 2.0 as it pertains to the equity markets. This is moving in lockstep with every halving cycle. And so, I think that, again, I'm biased towards buying opportunity. We're going to pay attention to the data, as we always do in making investment recommendations and investment decisions. But, for me, I'm thinking that this is just all lining up as would be expected if you start comparing it to like periods of time.
Right. There's certainly something to be said about historic where we are historically in the cycle of, we just had a new president. It's his first, quarter. He's still in the first quarter. And so this is all to be expected. Now, is it to be expected with the amount of decrease or the amount of pullback we've seen in the market? Maybe it's an outlier, but we won't know until we find sort of a bottom. So I would hope, knock on wood, that we find a bottom soon and then see sort of I think that if we do see that, I think it's going to be sort of a quick rebound. So I would also probably lay on the end that it's more of a temporary thing and we'll come back pretty strong.
Yeah.
And then again, we'll probably see this again in the next few months.
I would say end of summer. Yeah. When you look back at the almanac that you've shared in previous videos, would make sense. We're paying attention to the data. Any changes in the indicators, we're looking closely at to parse through the data to see if it makes sense to do rebalance, if it makes sense to change the allocation, and that's something that we're doing every day. We get data dumps every night on the technical data that we use for our portfolios, and we're keeping a close eye on it. But I'm liking where the country's at economically. I think that there is still weakness, and this is regardless of who's in the White House. We come out of COVID, which was like wartime type spending from the federal government. Right?
I think beyond that,
I mean, it was enormous, and then just social disruption, supply chain disruption, and it takes a little bit of time. And regardless, you're going to have periods of weakness for whatever reason. But I do think that some deregulation that's coming, some lower tax policy that's coming, I think that helps really undergird the market as a whole. And then again, disruptive technology, that no matter who is sitting in the White House, at the end of the day, it's nice to have an administration that's business friendly, but the disruptive technology is coming. And with the disruption comes wealth creation, and with productivity comes profits. So you're going to have, a lot of opportunity as the years roll on. And I'm talking about 10, 15, 20 years. And this is something with our clients we talk about when you're at retirement. You have to remember that regardless of what's happening in the job market, or regardless of who's in the White House or the Congress, you've got another 20 or 30 years that we have to build a plan for. So, right. You got to take all the things you see on the news with a grain of salt, and let's develop a good strategy that's data-driven. We all can have our biases and opinions on what's going on in the market, but at the end of the day, you need a plan that you can have a high degree of confidence on to carry you to your death, to your golden years, and then to St. Peter's Gate.
Food for thought. Food for thought. All right, so what are we looking at the week to come? We got a few stocks that we're looking at. Oracle obviously has earnings today. Adobe is going to announce on Wednesday. We've got retail stocks like Dick's, Ulta, and Dollar General. They often provide some insight into consumer resilience there in those sectors. And then we've got the software and AI infrastructure that we talked about with Palantir, Cloudflare, and SentinelOne. And then Boeing. We'll see kind of what happens there. But
is there a sound that's like wonk, wonk, wonk? Should be. Yeah, we should play that with Boeing.
Foghorn or something.
Sad what's happened to that company.
So this week also is packed with economic events. We'll just run through these quickly. JOLTS report is Tuesday. Tomorrow, Wednesday, we've got the big CPI print. Crucial read for inflation. Oracle reports on Wednesday as well. Thursday, we've got the PPI, the Producer Price Index, and the initial jobless claims. And then Friday, we've got obviously Adobe announcing their earnings, and then a University of Chicago sentiment on the March reading. It's an early March reading. So if we look at Wednesday, the Federal Reserve. Now, the decision for lowering or pausing on rates, again, is not going to come until next week, but they are going to have some information there to make, I guess, that decision easier. So if we look at the CPI print, you already talked about it kind of. What do you expect it to come back?
I think it's going to come back a little softer.
A little softer.
Yeah, I think we had some seasonal abnormalities that took place last month. I think it's going to come softer primarily because of oil at the end of the day. And then also interest rates are biting people. It's affecting, we saw that in inflation adjusted wages up, spending down.
Right. Yeah.
That's peculiar. That's not something you generally see often. So I think it's going to come in At worst, as expected. At worst, it's not. It's going to come in either as expected or it's going to come in less. And I think that we're already seeing sentiment in the market change on the Fed futures. We were at a solid 2 cut. Now it looks like people are pricing in 3.
The market, yeah.
Yeah, I think if you look at the yield curve, I think right now the way things are, I think 3 makes sense. And I think.
So do you think they'll cut in March? They're going to meet the 18th and the 19th. Are they going to come away from that meeting saying we're going to lower by a quarter point, or we're going to keep it where it is? We feel confident that we're on the right track, but we're going to keep it where it is.
I don't think they cut in March.
I also don't think they cut in March.
If they do, it would only be a quarter point. I think that.
Do you think that at this point they're going to cut more than a quarter point at anyone?
Yeah.
Really?
I think it's possible. Yeah, because the bond market is yelling at them. I mean, just look at it. The yield curve is wanting to steepen.
Made that the bond market has been yelling at for a long time.
Yeah.
So when are they going to start paying attention to that? There's been people ringing the alarm about the bond market for a long time about what it's saying regarding monetary policy.
I think what we could see happen in March is them give more clarity on their balance sheet roll off, because at some point that's got to stop because you're playing with fire.
So what does that mean? Balance sheet roll off when you talk about that?
So quantitative easing was when they were going into the market QE with new dollars and purchasing
printing money
to purchase bonds, mortgage-backed securities, and U.S. government debt. And they purchased corporate debt too, I think, during COVID. I could be wrong on that. But they purchased bonds. Now, quantitative tightening is where when those bonds mature, they're not introducing that liquidity back in the market. So what's happening is when the bond matures, then the Fed gets their money back and then the money gets deleted. So they're sucking money out of the system. And the balancing act is trying to figure out from the central bank is what is an appropriate amount of liquidity, just like what's the appropriate amount of inflation they target to, but that's just a target that was just made up. It's actually made up from the Central Bank of New Zealand, I think, in the year 2000. And it seems to have worked well, but each business cycle is a little different. We saw in the last business cycle that 2% inflation was very hard to get to. And so with onshoring of jobs and just a new regime change in general in the market, the argument could be made that 2% may not be necessary, that we may be in a business cycle where 2.5 or 3 is an equilibrium. So we'll see. But I think
people have also been screaming about for a long time, almost in the immediate aftermath of them announcing this 2% number from on high that's been gifted to us.
Yeah, I mean, it's just a made up number. So we'll see. I think that there's a lot of pressure right now on individual investors to carry the weight of the Treasury market, and that's tying up capital that could be used in other areas to increase productivity. Because when you're just buying a Treasury, you're not increasing productivity, because we all know the government's not the best at allocating those resources. But we also have the fact that in reducing the annual deficit, that's also going to take pressure off of needing to issue so many Treasuries. So, it is a balancing act, but I think that the Fed will, if I had to bet that they're going to do something that is newsworthy, is they're going to add just more clarity on their balance sheet runoff. That's what I think. So we'll see. We can place bets on it.
We will see.
Privately.
Yeah, we will. That's interesting. I don't know that. I was kind of shocked that they cut so heavily the first cut. It's typically...
the 50 basis point cut.
The 50 basis point cut was a bit much, I think.
I think that was political.
Yeah, it's possible.
I think they wanted to do it.
They're supposed to be apolitical, though.
Yeah. I think that they wanted to do it they wanted to get the amount of cuts they wanted to get done before the election, so they couldn't be seen as trying to,
sway
one way or the other. So,
I mean, I don't think they could have had any.
But what do we know? What do we know?
Yeah, what do we know?
Jay Powell, you're welcome to come on. And,
Yeah, Jay Powell.
So...
yeah, well, that's interesting. Yeah, I would tend to think they're gonna keep it where it is, at least for the next few months, and maybe we'll see what happens.
But I think the 3 cuts make sense for the year. At some point in time, if you're looking at what the bond market's saying now, it's steepening, except at the very front end of the curve, which the Fed controls. So it makes sense.
Well, we were talking about this too, because of the short term. The short term yields are still like 5% on a T-bill. So it's this was the conversation we were having was in the context of muni bonds versus, these bonds that are paying, these short-term bonds that are paying high interest, although it's taxable where muni bonds are not. But it's just an interesting conversation. It's an interesting thing to look at for sure. But a fun week coming up for sure. We'll see what it brings us. We'll keep an eye on everything here. Anything else? Any parting narratives, parting thoughts? Any topic come up this week with a client or anything that you talked about that you think might help anyone else?
Well, we did get some new developments on the Social Security Fairness Act. We had a first client receive their new Social Security check. They were affected by the government offset pension, where they were not eligible for Social Security because of their public service. They received their first check. We've heard of some other people getting letters. I have not seen anyone get the lump sum yet, which is going back to January of
Okay, so those are different transactions then.
Yes, they haven't gotten that. But so if you have questions about Social Security Fairness Act, if you've been for the majority of your life or the entirety of your life, if you have worked in public sector where you've not paid into Social Security, but you have a spouse that has, or if you did pay in enough to get a little bit of a benefit, but you've been hit by the windfall elimination or the government offset pension provision, then reach out to us. We can help walk you through what we're seeing with our clients. But, it's great that, more people that technically have always been eligible can now get a little bit of money. And this client's getting an extra $1,400 a month.
Yeah, it's a big deal in some of these cases because it affects it so much. The windfall elimination provision, when you start looking at that, we've talked about it before, so I don't want to beat a dead horse, but...
and if we get no taxes on Social Security, it's going to be even greater for these people.
Yeah, that's a good change too.
Yeah.
But those have a big deal. They offset a lot. They could be the difference between a couple $100, maybe a couple $1,000 a month. So if you're in that position or you think you might be in that position, call Social Security Administration. It's not going to be fun waiting on hold, but they'll be able to give you some answers. And, I might call 2 or 3 times because the thing about Social Security Administration is you get a different answer with everybody call. So if you feel like somebody's not understanding what you're saying or they're not kind of giving you answers that you're expecting them to do, just hang up, call back, get somebody else.
Yeah. And feel free to shoot us an email if you have questions about anything that we've talked about, if you're concerned about how your portfolio is being managed and would like a second set of eyes, be more than happy to have a conversation with you and talk about how we help our clients to see if what we do is a good fit for you. But in general, if you're on the sidelines, to find an advisor, talk to him, find one that you trust, that you get along with, and whose outlook aligns with your goals. And that's really good because you need somebody that can kind of see through the noise, see through the clutter, develop a good strategy that works. And get off the sidelines. Make sure you're contributing to your 401k. Make sure that you're contributing to your IRAs, your Roths.
HSAs.
Get them in there. HSAs, get it in there. Don't let what's happening, if in fact anything, now's the time to increase your contribution limits when the market's down. It's a great, powerful tool that you have at your disposal with your 401k to be buying into these dips. And it's going to make all the difference in the world. In fact, that's in your 401k more than the advice we give. And especially when you're under, I would say when you're under $200,000-300,000 in your 401k, the most important thing are those contributions.
Right.
Really, really they are.
Yeah.
Now you don't want to be in a cash fund. I mean, God forbid a bond fund. You want to be, even if you're just in the indexes, just keep contributing. Now, once we get over $300,000, that's where, our advice in outperforming what you otherwise would get is key. Because now, your growth, your potential growth rate is in far excess of what most people can contribute to your 401k, unless you're using a safe harbor plan, which we may need to do a show about that. Talking specifically to small business owners and how they can maximize their 401k contributions upwards of, if you have the right setup, we've gone in and set up some 401k plans. And if you have the right setup, you can contribute $250,000 or more annually, depending on how it's set up. If you're a business owner, significant tax savings. But that's neither here nor there today.
Conversation for another day.
Yeah, that's another day's discussion. But yeah, I would just say Social Security is probably the biggest thing right now. We're winding down our annual reviews. So the next season that we're picking up is really client referral season. So we do, the first quarter of the year, we focus very heavily on annual reviews, and then we kind of begin to shift our focus to people that are referred to our firm. And so if you are a client that's listening and you have somebody you'd like to refer to talk to us, all of our consultations, there's no obligation. We're not salespeople. There's no charge for it. Sit down and have a conversation. If we're a good fit, love to bring you on as a client. So if you have anybody you'd like to refer to us, momentumwealth.us, submit there's a form, there's a button, contact us button.
It is. Indeed. All of what you're saying is true. Yep.
Yeah.
Well, we are coming up on 48 minutes, so we'll cut it short here. Not cut it short, but we'll cut off here. But thanks for joining us today. Don't forget to like and subscribe. Share this with somebody. Listen on podcast platforms, audio platforms, YouTube, wherever you listen. And we will be back next week with more of this.
I've got to say the tagline that's on here. It's so great. You
What's
came up with
tagline?
it. Stay invested, stay informed, and keep the momentum going. I love it. That's great.
Well, now you
need
they
a pay
know that
raise.
we've got stuff on.
Well, we have to structure, keep our thoughts, because it's a lot to talk about. But yes, well, the video didn't end then.
No, we're going to end it now.
Okay.
All right. Have a good one.
All right. Take
Got
care.
some great lunch. Have some
Peace.
fun today. Goodbye. We'll see you later.